Good morning, everyone, and welcome to another edition of Money Matters right here on WNFM. This program is brought to you by Bank of Nevis.
Home. It means something different to everyone. It's a place you love, a place as unique as you are, a place where you can be yourselves, a place for life's big surprises, and not to mention the small ones. Moments to cherish and moments that last a lifetime. It's a place for nurture and a place where you can grow together. It's home. So whether you're building, purchasing, or renovating, the Bank of Nevis is here to open the door, giving you the confidence to dream and the help you need to get there with a mortgage loan from the Bank of Nevis. The Bank of Nevis Limited, improving the quality of life.
Yes, indeed. Welcome to another edition of Money Matters, brought to you by the Bank of Nevis, WNFM, and of course, our financial guru himself, Mr. Francis. Oh, sorry about that. Oh, hang 1 minute. All right, here we go one more time. Good morning, Mr. Francis.
Good morning, Sharon.
Good morning. Oh, nice to have you with us.
Right, glad to be here and hoping that we have a clear audio today.
Well, it's sounding clear enough for everyone to hear, and hopefully everyone is now tuning in
Wonderful.
for the program. And today we are tackling another big one. Let me first say, though, that Money Matters is a literacy public awareness program with financial coach and consultant Mr. Tally Francis. And the show is brought to you right here on 1FM and the Bank of Nevis. And it airs every Wednesday at 10:15 a.m. So welcome, everyone. We're going to be jumping into a really big ticket item. And you're like, well, what would that be? What's the biggest one you probably will ever pay once you decide to go down that road? It's your mortgage. Yeah, we're going to talk how to save money on your mortgage. So, Mr. Francis, we're going to jump right into it.
Sure.
Let's see. For most homeowners, let me just start off that way. The largest monthly expense, as I just mentioned, is the mortgage payment. What is a mortgage loan? We're going to start with the very basics.
Okay. Yeah, well, you're right. And as we say, glad to be with everyone this morning. And mortgage, yes, it is a loan. And in this loan, typically you're taking the money to purchase a home or to build one, even to refurbish. You can take a mortgage out to refurbish your home as well. And this is for the home that you live in, or it could be for any other type of real estate. And you would agree with the lender, usually a bank, a credit union, to pay back the loan over time. Typically, you make monthly payments, regular payments monthly. And the very big characteristic of this loan is that your borrowing is secured by the house, is secured by the land, is secured by the property that you now going to call your home, and the home serves as collateral. So the loan is secured by the collateral. The collateral is the same home that you take the loan to purchase or to build. And securing it meaning that if you as a borrower fail to repay the loan at any time, you come to fall short on payments that are due, the lender can take possession of the home, take possession of the property and sell it, using the proceeds then from the sale to repay the loan that you could not pay. So that's a mortgage.
All right. So if for any reason at all you fail to make payments on that home, does the lender then have to ask you any questions with regard to them taking over and selling your home?
You mean like asking you permission with it to sell?
Yeah.
No, not at all. And there's a legal process, and but in a nutshell, the lender, the bank don't have to ask your permission. The bank would have already asked you, say, 3 times at least, in writing and by phone. The loans officer may have called you, the recovery or the collection officer may have called you and, ask you, do you have this outstanding? This is long overdue. Can you pay it? Please come pay it. Pay part, pay whatever, So you'd have had that back and forth with the, maybe not even back and forth, because if you really couldn't pay, it means that you couldn't even answer properly when they ask you. So what then happens is that after that little procedure, and so they then are having the right, because it's a collateral securing the loan, and usually they would engage someone, the bank also would engage like an auctioneer or someone like that to advertise and sell the property, trying to get the best price, of course, but at the same time, ensuring that the property is sold so that the money you borrowed could be repaid.
And it doesn't really matter how far into the mortgage payments you are. If you lapse, the bank will take your property.
Lapse is a good word, because
I have to say lapse.
Yes, you lapse. You have not been keeping up. You have not been keeping up with your payment on schedule as agreed. Does it matter how far you got into the mortgage? No, it does not really matter, because what matters really at that stage to the bank is that you have an outstanding amount that should have been paid by now, and you have not paid it. You have not shown that you are able to pay it even. And so you get to a point where practically you can say the bank has no choice but to recover its money by using the collateral, which you had agreed to in the beginning, will be collateral for the loan. So, and that is, it really doesn't matter how long. If you had a 30-year mortgage and you had paid 20 years, you now have 5 more years to go. And what is happening, your situation is that 3 months, 6 months, 8 months, 9 months. I mean, if you think reasonably, the bank still needs to collect its money. It has 5 more years of money to collect. You can put it that way. And so this is why it's extremely important from the very beginning to, first of all, take out a loan that you can afford over the long term. The bank may help you determine what's a good loan, what can you afford, and so on, but you have to know what you can afford over the long term based on your plans and so, and based on your situation, your financial situation too. You cannot really predict what is going to happen in the future 100%, but certainly you can determine that, I'm going to take a loan that will be affordable for me over the long term. The second thing is very important to also make sure that you pay as agreed and pay on time. And thirdly, make sure that you are saving every single opportunity that you can during the life of the loan, including saving on the mortgage, which is wherever you have the opportunity to do that, you also do that. And so that if something happens, you reach hard time in year 5, in year 10, in year 15, you would at least have a little savings to take care of that mortgage payment, monthly one, as they come up.
I'm going to add a fourth. If you are running into a little bit of a problem, communicate with the bank and let them know up front. Don't let them have to be asking you a question, sending you letters all the time. Communicate with them before you see the problem approaching. Hit it head on, right?
That is extremely important. Communication for a mortgage loan or any loan that you have. It's important to communicate with the lender. And you're right, because if the bank will have to write you, it would mean one of the two things. Either they really can't find you and get a satisfactory response or discussion with you, or it would mean that they have spoken with you and you cannot come up to the plate. You are lapsing indeed, and so they have to formalize the procedure and the process to really demonstrate that they are making an effort to work with you, and you are unable at the time. But that's what happens when the bank has to move in on you for a mortgage. Most banks they're not interested in moving in on people for mortgages. They're not interested in taking the property and sell the property. They're interested in the loan, being completed, and you have your home. But if it comes to that and you are unable, it means that the solution would then have to be that. So you're right. Communication is a fourth one. Extremely important to communicate with the bank and communicate properly, truthfully, honestly. If it is that something is coming up and you think you won't be able to, communicate with them. There is one point that a banker will tell you, I'm sure. He would say that we are able to perhaps look at a restructuring or look at a temporary delay or something like that, and to work with you. Well, I'm not saying the banks will always do that, but I'm saying that depending on your situation, if you have the discussion, there's a better chance that you would be, you would have a lender, your friendly lender working with you rather than waiting until you can't pay 6 months, 7 months, 10 months, and then foreclosing.
Yeah. All right. So the amount that you pay monthly on to the bank, how is that amount determined?
Right. Well, in the setup of the loan, you have things doesn't really have to do with the loan itself that will determine how much you can pay. Things like your salary, what level of income that you have, and what existing debt that you have. If you have debts already paying, it means that when you take the mortgage, you add into that monthly debt that you have. Things like how indebted you are will tell that. What's your credit worthiness? Generally, the bank will try to figure that out. It would take a poll or an investigation, a background check here and there to find out how you have been paying. If you had previous loans already and you've been doing well with them, that also is one of the ways in which it determines. So the amount you pay every month is determined, though, by the amount that you end up borrowing. And so there are many other things that go into, like the amount of loan you will borrow compared to the value of the property that you buy. And so they work that out as well. A loan to value ratio, it's called. And, some banks wants to do an 80% loan, and 20% then is what you would have to put in. So you have the down payment component coming in as well. And so, you have all of this, but in the end, that amount that you borrow and the amount of years that you will repay, together with the interest rate that you are charged, will determine the amount that you pay every month. So if, for example, I take my little calculator here and I work that you are borrowing, say, $180,000, right? So you're going to borrow $180,000. If you get, let's take, let's say 5%. And for argument's sake, it's a 30-year loan. You're quite young. Right there on this calculator, the amount that I'm getting here is $996. So you have to pay $996 per month. What did I put in to determine that? The amount you will borrow, $180,000. The number of years that the loan is for, 30 years, and the rate that you will be charged by the bank. The interest rate is 5%. This is what I put in here. And in this example, you have to pay $996. Now, that monthly payment of $996 includes a repayment of the principal. And when I say principal, I mean the amount that you borrowed. We call that the principal. So there's a portion of the $996 that is going to pay down the principal. So from $180, it will be reduced in the first payment based on the amount that is in there. And the other part of the $996 is the interest, which is what the bank earns as its income from giving you the loan. So every month you pay the $996, you are paying now part of the principal, you repaying the loan in part, but you're also paying and compensating the bank for lending you that money at that time. And so that is how I would say in a simple way, that's how the amount is determined, and that is how the amount will be applied when you pay it every single month. Now, this mortgage is calculated for you by the bank. You get a figure, but again, it's extremely important that you make sure that it's a figure that you're comfortable with, that you will be able to pay over the long term, because you want to be sure that you don't be one that ends up lapsing because the amount you are having to pay every month is too high compared to what your plans are. Your plans today may not include may include certain things that when they come about, $996 might be too much for you. For example, you may be intending to have your second and third children being born in the next 3 years. So, those will add expenses to the family budget, which would make $996 perhaps too high for you. So you need to know and have that. So take the help of the bank, but also look at it yourself. The loans officer is there to do the business of the mortgage, but you have to be using the tips that we give you at Money Matters
Yes,
to handle
indeed.
your money well. Yes.
Yes. All right.
Yeah.
So here's a really big question now. How can we save on mortgage loans?
Okay, so saving on mortgage loans, again, it's a loan, so you do have to repay it. But we're talking now savings. So in the context of mortgage and savings, you have certain things that you can try to do, and we could discuss a few of them. And let me see if I could put up this here. If you have an arrangement to pay monthly, one of the ways in which you can save is to actually pay twice a month. You can make bi-weekly payments. So every 2 weeks you can make a payment. And what you want to do is every time you make the additional payment, you ask the bank to put that to your principal. Don't hold it there for the time the next payment date comes, but to pay your principal. You save because when you pay bi-weekly, what has happened is that you have 52 weeks in a year. So at the end of a year, you actually end up making 13 payments instead of 13 monthly payments instead of 12 monthly payments. If you pay it in that way, you get your extra there. That's a savings. But you want to make sure you pay early if you can, because that they apply it to the principal when you pay outside of the payment date, because what that does is that it reduces the balance, the principal balance on the loan between now and the next payment date.
So monthly. I mean, make 2 payments in the month as opposed to 1.
If you can. And this is very feasible for people who get paid fortnightly. People who get paid fortnightly, this is very feasible for them. People who also work on variable income, their salary vary. They get paid at different time, or even self-employed people.
Or maybe if they're doing something on the side as well.
As well, if you're doing something on the side, because this is feasible for you. That means because you come into money more often than once a month. So in that case, or you come into money at various times. So if I have the money today, rather than save it up and then put it to the payment on the 24th when it is due, I can actually pay it now that I received it on the 10th of the month. And so when I do it on the 10th of the month, what is happening is that between the 10th of the month and the 25th of the month, when the payment date I agreed on the bank is, that time the interest is on a lower amount because I've already put in, say, $500 towards principal. So that's $500 less for interest for the next 15 days until the next payday. So that is one way you could save. Now, not all banks would permit that to happen at that time, but once you have that same communication that you mentioned, you walk in there and you say you want to make the payment, you can make the payment, they will apply it, and it is something which is advantageous to you, but it's also advantageous to the bank because it means that you are being really very creditworthy in that sense. So that's one way in which you can save on the mortgage.
Okay, and another one?
Yeah, in a similar way, if you came into money, like you came into a bonus, you came into a raise, you came into whatever, that is lump sum, you can also make an advance payment. So when you make that advance payment, you are actually getting ahead. And imagine every time you get ahead on your loan, what has happened is that you're reducing the balance, but you're also reducing the number of years that you will have that mortgage obligation on your budget. Yes. So every time you get an opportunity, you can make an advance payment. Now, a lot of people don't even think about that because, you're comfortable, you're in the bank, all right, your salary is going and so. But even when you make an advance payment, if you came into hard time 5 years before the mortgage is finished, because you have that track record of having made good on your payments and better than was arranged, you have a better chance, a better opportunity of having the bank, be, I wouldn't say lenient, but working with you, be very accommodating to your situation at that time. So you would have, if you were in the countries where they do credit score, it means that your credit score is
would be
good.
Mm-hmm. Really good.
Yes.
Mm-hmm.
But if you are with us, you're actually here being put in the book of a good credit worthy person. a good paying person. You know the difference between a bad pay and a good pay?
Oh, we
So a
know. I
good
think all
pay.
of us know.
So you imagine you're in a good pay segment of the bank's book, and that helps you.
Okay.
So another way you can save on mortgages is to let your loan go for a shorter period rather than for a longer period when you're setting up the loan, if you can afford it. Now, remember, the longer the loan is, in the life of the loan, is the more years you pay in interest, and therefore it is the more that the property is costing you over time. So one way you want to to save on your in your own budget, one way you can save is by, when you're setting up your loan, if you can truly afford a 20-year loan, do a 20-year instead of a 30. If you can truly afford a 15-year loan, do a 15-year instead of a 20. And the reason is that the longer the loan for the same interest rate, it will be the more interest that you pay over time on the mortgage. Now, you can shorten the amount you pay on the mortgage in two ways. One of the ways is that you can agree to pay a larger monthly amount every during the life of the loan. That means if you can pay a larger monthly amount, it means that you're not bound to spread such a longer period. But the other more important way is the down payment. How much of the property can you own for yourself by putting in a bigger down payment so that you have to borrow a smaller loan? So if you have to pay $200,000 for the property, can you actually put up $40,000 instead of $20,000? If you are able to put up $40,000, you are borrowing less. And if you borrow less, then for your lifetime, you are paying less interest on the mortgage loan. So that's another way in which you can save yourself from having to pay a high number in terms of the amount of money you're paying on a mortgage. So you want to look at it that way, you see, Sharon, because it is never really that you walk into the bank or the credit union and then once you're in there, the lender is working things out for you 100% to your best interest, because remember, they're also doing business. But not only that, you know more than them what's happening with you, and perhaps they didn't ask you a question like your family size intended. They didn't ask you a question like, you know, what are you going to do in terms of your car habits? Are you buying cars every 3 years instead of 5 or 6 or 10? Are you buying new cars always instead of, valuable used cars? So you may not have had that kind of discussion. So you want to take that into consideration. The bank wouldn't know whether your aging parent would be a dependent of yours as well. So those things, you have to think of them while you're setting up your mortgage so that you can save and save well. So this second way was to have either a larger down payment or a larger monthly payment so that you can have a shorter number of years that you take out the mortgage for than a longer number of years, because the shorter number of years is the less interest that you pay.
Okay, so now that if you choose to go that route, now that you have this money, some people might consider maybe investing it in something like maybe stocks or bonds or something else. What are your thoughts on that?
Right. What do you do with the savings? What you do with your savings? You want to do the first thing you want to do. You want to do that which makes you financially healthy with less stress. And one of the first things that helps you to be healthy with less stress is your emergency fund. We're going to talk about that sometime in another program, but you want to have an emergency fund. You build up the emergency fund. The emergency fund for one person and one family would be different from another. So it's not a figure cast in stone. I am familiar with a financial advisor who says in his program, $1,000. Make sure you have $1,000 set aside, and that will take care of incidentals. It will take care of your car breakdown. It will take care of a quick medicine that you need for yourself, for the children. It will take care of the stove break off, the knobs break off, the buy some knobs, something like that.
Plumbing issues, because they'll seem to prop up every now and again.
the water just leaking off the place, you don't know where it's coming from. You gotta pay the plumber comes in, he tells you, but you need this elbow and you need that thing and so on, this whole thing will cost you $400, just like that. That's an emergency.
Yep. Mm-hmm.
So if you are saving on your mortgage, one thing you want to do first and foremost is to put that money into true emergency savings. Once you have that emergency savings, then the next thing you need to do is to ensure that in that savings money that you have on top of emergency, you pay attention to the house itself. Now, a lot of persons don't remember that once you come to own the house, you have expenses that go with it. Not just the simple plumbing, as you mentioned, emergency, but you have to maintain the house. So you must do a little painting in X or Y years. You must take care of the door handles, the hinges, which, tend to, and if you have children, I mean,
oh boy.
Again, they take care of the house in a certain way that makes your maintenance money. So if you are saving on your mortgage, you also want to ensure that you have the emergency, but you also have your house maintenance money there. Now, property taxes is another thing that you have to make sure that you're putting aside money for. So you want to have those monies there. Now, in some mortgage loans, the mortgage lender already boils up inside the amount of money that you have to put aside every month that they hold back from you or receive from your salary every month. They make sure that there's a portion for the insurance of the property, because the insurance is for a whole year, but you have to pay it at one time, and it's anniversary. So you save up that money every month so that when the anniversary comes, you're not going to look to your family or look to the same bank to get some money to pay that insurance. It must be insured. So you would want to insure the house as well. So those are the things you would want to do. That's how that's how we think in handling the money. So we come back now to the 50, 30, 20 sort of budget rule. And so that savings is not even in the 20%. That savings is in the 50%, because it's essential that you have that money to pay the interest, to pay the insurance, to pay the taxes on the property as well. In addition to the money that you pay in the bank every month, you should be saving every month so that you can comfortably pay the insurance when that time comes around.
All right, we only have a few minutes left, but something that you said earlier made me want to ask this next question. Is it better to buy property or rent property? I hear this debate all the time. I remember hearing one person say, it's better to rent. And I'm like, but if you have your own, it's still yours. So I didn't agree with him. What do you think?
Right. Let's agree on one little thing, that I'll give you a short answer now, and we could come back and discuss that at another program.
Okay.
But buying or renting indeed is a big subject. Now, if you rent, you don't have the ownership at no time at all, neither now nor in the future. So what you are doing is you're actually paying the landlord, and the landlord, you're paying him for use of the property. The landlord now takes care of all the things that I was mentioning earlier, like your maintenance and your taxes and your insurance and so on, all those additional things, and your incidental, if an emergency come up, depending on what it is, your landlord has to take care of it. If you own the property, you have to take care of all of this. And you have to take care of the tax, the insurance, and so on. And you have to take care of the maintenance. If you have a mortgage, then in addition to the mortgage, you're taking care of those things. So what you think about when you're thinking of owning and buying is you own, you have the peace of mind that no landlord can come to
and throw you out. Well,
ask you to leave,
ask you to leave.
for whatever reason they have, yes. You also don't have the problem that inflation going up and this man want to raise the rent. So you don't have that problem of rent being increased on you. Neither now nor in the future, because you own the property. So, in that sort of peace of mind makes it better to own the property than to be renting the property. But that's like a nutshell of things, and there are so many other things we could speak about in terms of the difference between owning and renting. I should tell you, Sharon, that for some people, renting is better than purchasing. For some situations, purchasing is far better than, and owning is far better than renting. But if you're in a position where you're debating it right now and you say early in life, it's a good thing to save so that when you purchase, you can purchase for a shorter time. You can purchase with a mortgage for a shorter time. You can purchase with a mortgage where you are paying more on your principal per month, and your down payment, you save in so that your down payment make you to borrow an affordable mortgage loan.
All right, another great program, Mr. Francis. Thank you so much for joining us, and for you, our listeners, as well, for joining us, and those online on social media on our Facebook and YouTube platforms. Thank you for joining us as well. We will meet you right back here on Wednesday, so that's next Wednesday morning, from 10:15 until 10:45 with Mr. Francis and Money Matters. Any ideas as to what we're discussing next week, so we can give them a little bit of a heads up?
I like the buy or rent question, and so maybe I'll take a look at that. But we will still be talking mortgage, and so we will do either buy or rent, or we will do home repairs. Savings on home repairs, or should we buy or rent, or we will merge them together. We have 30 minutes, don't we?
Yes, we do. We could.
You know, some people are very afraid of mortgages. There are some people afraid of mortgages.
I mean, honestly, rightfully so. Rightfully so.
But you don't have to be. Communicate with your lender, communicate with the bank, and you will be good.
All right. Thank you so much, Mr. Francis. We look forward to hearing from you next week.
Thank you.
This program is brought to you by the Bank of Nevis.
Have you heard? Owning your very own special piece of St. Kitts and Nevis has never been easier. The Bank of Nevis Limited is currently offering 100% financing with up to 15 years to repay at a competitive low interest rate. Additionally, a Visa credit card to make your day-to-day shopping needs easier. Contact us by phone or call into any one of our branches today. The Bank of Nevis Limited, improving the quality of life.